waiting for the go ahead and I don't hear it. Make sure. All right, so I have to assume I'm going. All right, this is Corning, May 2022 stock valuation. I have to say right away that because we are coming to the end of our fiscal year and we are going to reshuffle and rebalance everything starting July 2nd, that I don't want to make any trades um, this month. And so while it is important that we do the valuation to, verify whether or not this particular position is a good one to be in, or if this is a position that we can add to, I am not going to be adding or taking away from this position currently. With that being said, let's quickly look at a few numbers here from the results. All right. From the financials, rather. First things first, as always, I do not include goodwill. Also, did not include other intangible assets. These intangible assets have to do with purchases that Corning makes and necessary to produce goods that have been contracted for. Exactly the details of that, I'm not sure. They didn't specify that in the financial notes. However, they did say that this was a small number and not anything to really be concerned about, so I left it out. Um, Other assets is really important to talk about. Corning, because they produce products in other countries, they have a lot of financial contracts that they use to hedge their cash position, basically. So if they're using, let's say, the Taiwan dollar, whatever it's called, to purchase materials or to pay their employees in Taiwan, then they will, of course, have to purchase those Taiwan notes in order to pay out in Taiwan dollars. Of course, everything that's being reported in their financials is US dollars. And so what happens is when they do the conversion based on their different, like I say, financial contracts, they book that into other assets, and it also gets booked as other income on the profit loss statement. In their most recent earnings call, they did say that they don't plan on making any changes at all to um, any of their cash hedging strategies, even though, of course, we know that the dollar has definitely lost some value. And we've also had some currency movements in some of the other Asian countries as well, but they said that they don't plan on making any changes. So we have to assume that everything will remain um, as as we see here. One example of that on the profit loss statement is the translated gain on the Japanese yen, right? And so again, this is because not only are they entering into these financial contracts to hedge their cash position, but they're also getting foreign debt as well. So they're getting loans, right, from Japan, which is of course denominated in Japan currency, right? And they're making those interest payments on that debt with, again, Japanese currency. But everything that we're looking at today is in dollar form, okay? And so every quarter, they're going to have a gain or a loss on that currency conversion. Let's take a quick look now at what that looks like on the balance sheet. So this is 2022. We see that their cash position has really kind of been up and down over the last 3 years. So we do expect the cash position to fall. Currently, it's standing at 2016. We expect that to fall to 19 in 2022. Whether or not that happens, I don't know because it's never been at that 19 level in the last 3 years. But again, just based on a simple average, of what it has done over the last 3 years. We expect it to fall. All right, accounts receivables. Accounts receivables, again, kind of all over the place, but for the most part, the accounts receivables have increased. And again, going back to the earnings call, we know that they are getting into the solar game, and they're saying that they are seriously, selling as much as they can make. So we expect the receivables to increase, if even slightly. So currently, receivables are sitting at 19. Last year they were at 2,000, and so again, having the receivables stay pretty much where they are, but increasing a little bit, I think it's okay. Um, because of course we know that again the solar panels and things like that will continue to rise. But what about the TVs? Corning has this idea that TV sizes will continue to increase, and I mean historically that has been the case. But at some point we know that TV sizes at some point are going to have to level off because we can't have we can't have TVs taking up more real estate than what the average person has in their home. So um, we expect the TVs to come down some, especially because we know that consumers are faltering a bit. And so again, receivables ticking up just a bit, but I don't see them falling at all. All right, inventory. Inventory has slowly increased over the last 3 years. It's always been up by a little bit, so we expect that to remain. It's currently sitting at 26, and so we have inventory at 27, which is sort of a decent jump, almost 10% from last year. And so again, maybe that number comes down a little bit, um, but it's already up 10%. So if inventories remain high or they go up, typically that means that they're selling less. And guess what? Again, faltering consumer, that's definitely not out of the realm of possibility. All right, other assets, again, these have increased by, small amount over the last 3 years. Currently sitting at 44. We expect that to increase. So we have it at 45, which is a fairly large increase from last year. But again, maybe that's something that we can play around with once we look at the final numbers. All right, property. Property has, again, slowly increased over the last 3 years, so we expect that to continue. Currently, it's sitting at 15,780, which is a bit less than what it was in 2021. So if we see an increase that we've been seeing over the last 3 years, we can expect that number to jump up a bit. But again, that's something that maybe we can pare back a bit, when we look at the numbers. All right, so total assets on the books, 27 is what we're predicting. Currently, it's sitting at 26, which is a small increase from last year, 26.5. We know that over the last 3 years, we have seen a relatively small increase year over year as far as the balance sheet goes. There was a small number down last year. And again, this is not including any intangibles, okay? So if you're looking at the official balance sheet from the company, those intangibles are included, and those tangibles may be up or down. But remember, those intangibles are not real assets. They can be something as simple as a customer list, or maybe I'm sure they have lots of what do you call it? Intellectual property, right? Because of course, patents. So a lot of their patents are going to be intangibles, which do have real dollar value, of course. I mean, if the company were to sell today, those patents are going to have to be sold at some value. So there is something to be said about increasing the balance sheet numbers based on that. But again, I'm always looking at basically worst case scenario, right? So the worst case scenario happens. I want to make sure that we're going to be good. All right, the pension. Pension, of course, this is an old company, and so their employees are still getting a pension. That number last 3 years has come down just a bit. It's currently sitting at 620. We can expect that number to increase. Okay. Now, I do have to say that a lot of times the pensions are tied to the market. So when we see the market drop off, a lot of times we will see the pension numbers come down as well. Uh, Currently sitting at 620, was 622 last year. In 2020, when we had a big drop in the market, we see that the pension numbers actually increased. Um, what that means for the pension right now, who's to say? The company hasn't said anything about it. As far as we know, nothing important is really going on as far as the pension is concerned. So again, that can be a number that we can play around with, but I'm comfortable at that roughly 673 number. All right, total debt has slowly increased over the last 3 years. Not a great thing, not a horrible thing. But we expect it to increase as it has consistently over the last 3 years. And for our total liability, again, growing liabilities, but it appears that let me see, yeah, the liabilities are growing faster than the assets. Not a great thing. Again, remember, intangibles are not included in this. Um, but liabilities are growing faster than assets. We expect that to continue. And so last year we were at 17.6. I'm predicting roughly 18 again, um, just based on the numbers that we have here, the pensions, debt, so forth. All right. The balance sheet again is declining. Okay. It's currently at 91. All right. Last year was at 89. So the question here is, if the balance sheet has declined consistently over the last 3 years, but we currently have a growing balance sheet as of Q1 2022, does that um, remain, right? Will we continue to see this growing balance sheet, even though it hasn't happened the last 3 years? I'm guessing that it's not going to happen. Now, what has to happen to drop that 91 down beneath the 89? I'm not sure. Maybe it's inventory, which would be a really great thing, right? Um, Maybe it is the pension. Um, Not sure, but either way, we know that this 91 number is probably not going to happen. So again, we're predicting 86. All right, so number of shares was a bit difficult to come by. Um, the financials don't give. Let me see if I can go back to it real quick. Financials don't give a specific number for the current year or quarter. But I was able to get a specific number for previous years. So as you can see here, shares issued 1.8 billion. Okay, and so what that means is that we're missing all of the dots, right? I mean, 1.8 billion is literally this 18 number that we see here, right? But what we want to really have is something like a four decimal place out at least, as we had in the previous years, 1726 and 1718. Either way, we do know that the share amount has increased slightly and consistently over the last 3 years. Currently, like I say, we're sitting at 1.8 billion. We do expect that number to increase by year end. Um, the way that happens is that shares are issued for typically compensation, whether it be executives or whether it be employees. Um, I'm not so sure that Corning ever really uses uh, the stock to raise money. That's not something that I've heard talked about at all recently. So I don't think that'll happen. But I do know that they will issue more shares for, like I said, executive pay and employee pay. And so we do expect that trend to continue. Whether or not it ends at 1843, I'm not sure, but we can be certain that it will increase from where it is now. All right. That gives us a book price of $4.67. And I do want to quickly just kind of show what happens to that book price if we play around with the number of shares. Okay, so book price of 478 versus a book price of 467. So we're talking about, 12 cents, right? But that 12 cents changes our price quite a bit from 21 to 34, 20 to 33. So it adds an actual dollar onto our stock price here. So again, something that we can play around with, but do expect it to definitely increase. All right, so book price, like I said, $4.67, 4.99 last year, 5.61 year before, and 5.75 the year before that. So what this tells me is that the book price is declining because we have a declining balance sheet. And again, I expect that to continue even though the balance sheet is currently above last year. I don't expect that to continue. All right, price to book currently at $7.54. And this is literally just the number of shares divided by the current stock price, which is currently $35.22. Okay, so that means for every share of Corning, $7.54 of that share price is made up of the actual value of the company without including those intangibles. All right. And I keep going back to that because unlike a lot of other companies evaluated, when you're dealing with a technology company, a lot of those intangibles are patents and they do have value. The problem is trying to tease out exactly what the value of those patents are relative and compared to all of the other intangibles that the company has on the books is really hard to do and not readily available based on the financials that we currently have. Something that I really think if I were an analyst on a call, I will definitely ask of the executives just so we can figure out exactly, how much of the intangibles is fluff and how much of it is a real value. And then furthermore, how are they, are they sticking strictly to, a market-based approach to figuring out how much the patent is actually worth, right? Or are they only looking at what it costs for them to have this patent? And the reason why I'm saying that is because in accounting, in some cases you have a choice, right? So typically the money that you pay for coming up with this technology or coming up with this product is all going to be the value of the patent, right? That's how you evaluate a patent. However, you can also actually say to yourself, okay, how much can I actually sell this patent for today if I were to sell it, right? That's a market-based approach to evaluating intangibles as well. A lot of companies won't use that approach, but it is important in management of the company. And I'm pretty sure there's someone at that company that is doing this, right? Because, it's an asset that you can sell and it's an option on the table. What if they sell the patent to Gorilla Glass? What if? I mean, how much can they get for it, right? And so I really want to know those numbers because when I'm evaluating a company, I'm not concerned about how much they spent on the patent. I'm concerned with how much is the patent worth. If they were to sell it today, what is it worth, right? So we don't have any of those numbers in these. And so that's the reason why our book price and price to book and all that stuff, we know for sure is going to be a low number, okay? Now, with that being said, because all of the numbers that we're looking at are the same across the board, right? Meaning that the intangibles have been taken out of all of these, we can at least make a comparison between what is currently on the books and what the company has done over the last 3 years. Okay, so currently, the book price makes up 13% of the current stock price. Okay, so the book price makes up 13% of the current stock price. The rest of the stock price, we have to assume, is going to be either profit or it's going to be what's called intangible value. That's the price that persons are willing to pay over what the company is actually worth to own this company. And the reason why people do that is because they assume that the company is going to continue to make money, and as long as they own the shares of that company, they will continue to make those profits. Okay, so over the last 3 years, well, last year rather, we know that the price has gone from 46.82 down to 34.81. When the stock price was 34.81, which is the lowest it was in 2021, it made up 14% of the stock price. When the stock price was at its highest of 46.82, it only made up 11% of its stock price. Okay, and the reason why is because as the company does better, people are willing to pay more money for future profits and not so much for what the company actually owns. All right, so the fact that we're sitting at 13% lets us know that we are at the bottom range of where this stock price can be. All right, now compare that to 2020, and the highest it was in 2020 was 38.44. The lowest it was 17.44. Now, when the stock price dropped all the way down to 17.44, that meant that 32% of the stock price was made up of the actual things that the company owned. Okay, that's a really low number, and it has never been that in the last 3 years. In 2019, it got down to 21%. So the question becomes, can we get back to these 2020, 2019 numbers? I think it's possible, but I'm not quite sure what takes us there. Again, I've said this before, but we will have to see lots of layoffs. We'll have to see a lot of people out of work and not with any extra money to spend on technology like phones and TVs and things of that nature. As of right now, there is definitely a fear in the market because of inflation, because we see the consumer spending less money. But you know, there's not any doomsday scenarios quite yet. All right. So again, 15% was the highest in 2020, and so we're already, you know, past that. So I think we're doing good there. 2019, again, 16 was the lowest. 16 was the highest. 21 was the lowest. And so again, we're past that. Again, can we get there? We can, but I think that is a real doomsday scenario currently. 13% is right in the middle of where we were last year. And so again, while we do have, again, a doomsday scenario of a stock price of $20.60, I don't see that happening for quite some time. And again, we can actually add a little bit to this simply because we don't know where these shares are going to end up at the end of the year. And we also know that if we were to add in those intangibles, that's also going to increase the share price as well. So let's go ahead and do that. Let's see. Let's just add to the other, and let's just give it 1,000 for the intangibles. And so that gives us 23, again, doomsday scenario, 37.66 as a high. That does currently make the stock price undervalued, and I can support that notion. Let's go back and let's add 500 for intangibles. Again, that gives us 35.70 on the high end, 21.80 on the low end. And again, we're playing around with about $1 of share price that we're just not sure of. And so, again, undervalued as far as the book is concerned. Let's take a look now at the dividend. And currently, the cash, like I said before, is the lowest it has been in the last 3 years. Whether or not that remains the case, I'm not sure, but we do see that over the last 3 years, it has declined. The cash on hand covered the dividend almost 2 times in 2019 and 2020. 2021, it covered it 1.24 times. Now it's barely covering it 1 time. So again, this has everything to do with the number of shares. If we took the shares down to 1,800, it still only barely covers the dividend 1 time. But what that means is that if the company wanted to, they can use all of their cash that's sitting in their pockets to pay the dividend, and that lets me know that the dividend is safe. It's not going anywhere. There's no there's no risk to the company not paying the dividend because they don't have the money to do so. All right. Now, dividends legally come from profits. Okay. And so when we look at the profit that the company generates and the actual dividend number, we see that the profit actually covers the dividend almost 1 time. And that has been the case for the last 2 years anyway. 2020 and 2019, we see that the profits obviously were not as high, and so it didn't cover the dividend. But Corning has paid a consistent dividend on time every time for the last 10 years. If that were not the case, then we won't be able to invest in this company. And so again, we can see that the dividend is obviously safe. All right, so let's go now to profit statement. All right, revenue. Now this kind of goes back to the inventory conversation and the receivables conversation. Revenue has increased consistently the last 3 years, and so we see a big jump from 2020 to 2021. We expect that to continue. Currently, the revenue is only at 36, but it was 14 last year, 11 the year before. So we do expect a big jump. And I think this is going to really be a turning point in this company, right? Because again, there's all this fear concerning consumer, but we know that Corning, even though a large portion of their business is does concern the consumer, they are selling to businesses for the most part. And so, your Apples and your Samsungs and all these guys that are going out and purchasing glass for these phones, the question is, do they buy less in anticipation of their customers buying less, or do they continue to buy just as much glass as they've always bought, with the understanding that they're going to sell the phones anyway, right? Corning, and I'll have to go back and look at the last earnings call and maybe the one before that, where they discussed inflation. And to my memory, inflation is an issue, but I think that the company said that it's not a big issue. So if revenue continues to increase, or even if it stays, relatively flat, I think we can really see a turnaround in the stock price, especially because, it obviously seems that, Q2, Q3, and Q4 is going to be their biggest quarters as far as revenue is concerned. All right, cost of goods sold. This number has steadily increased. Again, not a great thing, but it can also mean that the company is going into different industries and doing different things. And that's why they're spending more money to create their products. Typically, you want to see that number come down, right? You want them to see them spend less money and make more money. But that is not typically the way it goes. So again, we expect it to increase, and I'm looking at, let me see, B24. Okay. This is just based on what their gross margin has been over the last 3 years. We know there was 65, 69, 64, 65. So we expect it to be about 66, which is a bit higher than what it is now. Payroll again increased, and we know that with inflation, labor costs have increased, so we do expect that to increase. And we just did basically an average of the last 3 years to figure out what that increase may be. Taxes have been really all over the place, and so whenever you have large swings in numbers like this, you can't really use an average. And so we did a standard deviation to try to get an idea of where the tax number can go. Currently sitting at 180, but it was 491 last year. And so the standard deviation kind of gave us a middle ground of roughly 300. Whether or not that's the case, I don't know. If we see revenue increase, that can definitely be a factor. But again, just something that we have to kind of look at. All right, and again, this goes back to their financial securities, their cash hedge positions, and currency conversions. Again, number has really been all over the place. Over the last 3 years, they've actually lost money in this department. They did make money in 2021. So what's going to happen in 2022? Hard to say. Currently, though, I think they're up. Let me make sure. 29. Yeah. So currently, they're up on their cash hedges, and earnings call says that they're happy where they are. So I left that number flat. Trying to tease out based on the numbers, just you you can't come up with anything good. If they lose, they lose. I mean, they've lost in the past, but I expect it to stay flat. Maybe it increases. I don't know. All right, interest expense. Um, let me make sure it's an expense. 30. Yeah. So this is interest expense. Again, this would be the interest that they pay on their loans. And obviously, because they have consistently increased their liabilities, we expect their interest to increase, especially because we know that rates are rising. Even though some of their loans and things of that nature are in other countries where maybe rates aren't rising as fast, we know that rates are rising, and so we expect that number to increase by quite a bit from 2020. All right, research and development. This is all the money that they spend on coming up with new processes and new products. And that number has been kind of, all over the place. It's up 12% 1 year, down 13% the next year. Currently, it's only at 248. Last year was at 995. So we expect that number to increase just a bit. Again, that's a number that we can play around with, honestly. But as of right now, I have it predicted to increase. All right, investment. Again, this goes back to a lot of their cash securities, investments, and that sort of thing. Again, number has been just really all over the place. It was up 2019, 2020, failed 2021. Currently at a negative right now. And so again, just going to keep that number the same. I don't expect that to really move around much at all. All right, growing profit. That's the one nice thing about this company. A declining balance sheet, but growing profit. 16, 50%. And so we expect that to continue. Um, and so that gives us an earnings per share of 94 cents, meaning that at the beginning of 2021, if the stock price increased solely based on profit, the stock price ought to move up at least $1, at least, right? And so that's what that means because their profit is 94 cents per share. And of course, if we decrease the number of shares from where we have it now, that's going to increase the earnings per share. Historically, earnings per share, again, has increased. 94 cents is not far off of where it was last year. But historically, though, this number has increased quite a bit. And so, again, it's very possible that we'll see a nice turnaround for this company. Who knows, quarter two, quarter three, quarter four. All right, PE ratio. Um, PE ratio for this company historically has been between, well, it was between 50 and 60 in 2019, but otherwise it's been between about 30 and 60. And so currently we're sitting at 60, which is the highest that it has been in quite some time. And what that means is that currently people are really excited about this company. They're willing to pay a lot more for the stock than what the stock is actually worth. Okay. Now, it can also mean that, we are at the very top of where the stock price can go, and it's only down from here, right? Because we can definitely get down to this PE of 30 or the PE of 40. Looking back again at 2020, we know that the 2020 stock price was really, really low, not only for profit, but also for the book value as well. And so I don't think we get down to that 30. Okay. I don't think we get down there. But when you look at 2019 and you see a PE of 50, right? Then that gives me a little bit of pause because it's very possible that we can get there again for sure. 50 was the highest it was on last year, and so currently we're at 60. So again, gives me a little bit of pause, but I do want to look at something because when I saw that, I went and pulled up the PE ratio for all of the companies currently in the technology sector, and we see that Corning has the highest PE ratio currently. Okay, and I think this says everything to what I've said, which is Corning is in a really great position. They're in a really great position because while um, they do have this consumer-driven business. Um, Corning is really more of a consumer defensive company because a lot of the things that they make have to get made. Their medical side of their business, where they're doing glass vials for drugs and stuff like that. I mean, that kind of stuff has to get made. And so, while it is possible that people won't have the money to spend on medicine, and so drug companies don't make as much medicine. Like I said, something drastic really has to happen to get us there. And so, Corning, while they are a technology company, are really more of, like I said, that basic materials, that consumer defensive type firm. And I think that's the reason why their PE ratio is so high amongst their peers. Also, when I pulled this up, the first thing I saw was the dividend too. Their dividend is currently roughly 3%, which is one of the highest in the sector. IBM being the only one to beat them out. So there's just a lot of great things to be said about this company. And so when I see that, then the PE ratio here makes a bit more sense. The other thing I think is really interesting, I'm not sure if I've seen this before, but the profit as a percentage of the stock price is only 3%. Okay. That's not what's interesting. The interesting thing is if you go back over the last 3 years, That number has not moved at all. It's been between 2 and 4% for the last 3 years. And so now, when you think about the fact that profit has continued to grow, right? We know that there's a higher PE ratio for this company. It means that basically, no matter how much money this company makes, their stock price is going to be tied to roughly 2 to 3% of the stock price. Okay, basically, is what that means, right? And so, currently, as of right now, this is based on our prediction. Okay, for the year, it puts us at 3%. Okay, um, the the PE ratio on the low end, okay, we have predicted at 39, which is exactly what it was last year. Okay, it's currently at, let me make sure I got this right. No, no, no. Sorry. This 60 PE is an average. I apologize. This 60 PE is an average of the last 3 years. The current PE, I don't think I have it calculated actually. So I don't have a current PE for this company. I do have earnings per share, which I could figure out the PE from that. But either way, the point is we're looking at 60, between 60 and 39, which makes a lot of sense to me. Okay. So that gives us on the low end a stock price of 36.93, and on the high end a stock price of 56.92. I don't think we get to that 56.92. Again, that 60 PE is, you know, not the highest it's been, but it's at the high for sure. And the 36.93 on the low end, I think is more of where we currently are, right? And so at a stock price of 35.22, again, that undervalues this company by at least $1 to $2. Let's play around again uh, with the shares, and we'll just put it at the 1.8 billion that they have listed. All right. And so again, it gives us now earnings per share of 96 cents instead of 94 cents, but it then increases our predicted stock price by at least $1. So 37.81 to 58.27. So again, this undervalues the company by quite a bit when you play around with the shares. And so again, I am saying that Corning is definitely undervalued. I'm not willing to give it a price of $58.27. I will, however, conservatively say that the high for 2022 can definitely reach the 37.81, if not a bit higher than that. So again, Corning undervalued May 2022.